My title that's listed in the program was maybe a little bit, I realized probably didn't get to the point quite as quickly. So this talk's going to be, I think, quite different than the previous three talks. It's going to be a lot more historical, talking about situations that have happened in the past where people have designed very similar economic systems. And it's going to be illustrated via the lens of algorithmic trading. We're going to try to make this pretty concrete. So yeah, and well, I don't know where ZX is, but I'll try to not bleed into his time too much because I know we're like half an hour over. So just a very tiny background. I spent the last 10 years working in ASICs, which is kind of how I figured out a little bit about Bitcoin. Algebraic geometry and in finance at two places, D. Shaw, and at a high-frequency market maker called Vatic. And basically, I started Gauntlet when I started realizing the kind of people were like being a little like not so statistically honest in the space. People were kind of like choosing numbers randomly and weren't doing kind of the modeling that was at least to the level of like what Charlie described yesterday for Uniswap. So maybe roughly speaking, we're going to go through a few things, but first we'll kind of go through an overview of the problem, and then we'll talk about the history of why electronic markets from the 80s to now kind of resemble a lot of the advances that we've seen in cryptocurrencies, more so than, say, the internet. I think that there's always this view that cryptocurrencies and blockchains will be the next internet, but at least what you see right now on the ground looks a lot closer to markets in the 90s. So basically, complex technologies have been used in finance for a long time. I know this sometimes is a little bit surprising to people in this space and in tech, but there are definitely regions of finance where the newest technologies are used and people are much closer to research. Token economics is definitely financial modeling, but it's a little bit different because these decentralized systems change the interfaces and change some of the assumptions. And sort of probabilistic simulation is a good tool for kind of estimating this type of stuff. I couldn't figure out which of these two slides I liked better, so I chose both of them. But I'm going to give you a quote from my favorite journalist, who is Matt Levine. He's a former derivatives lawyer who writes for Bloomberg. But he has this view that people in cryptocurrencies generally tend to be relearning the lessons of finance's past just faster. And I definitely think that seems to be the case based on most of the lessons we learned. So where are the similarities between trading and cryptocurrencies? At the end of the day, when you get down to like what your client is doing or what the virtual machines are doing, they're figuring out how to prescribe a precise value to each packet that's received. So every TCP or UDP packet you get has some well-defined monetary value. The monetary value is tamper resistant because of the cryptography. So whether it is a cryptographic hash function or whether it's zero knowledge proof, so MIMC, some type of more complicated hash function. But the network value is driven by incentives and competition. Like the network value that ensures that the network stays live and accepts new transactions, and the network value that ensures that if a bunch of nodes drop out, there's still always enough incentive for new nodes to come online and to keep the network alive. But this is not the first decentralized packet monetization tool. Traditional electronic markets actually have a lot of decentralized features to them. And the only difference is really the monetary value is insured by the Fed and the SEC. And the network value, ironically, as we'll see, is quite largely driven by regulation. So let's go through a tiny history of electronic trading. So in the 70s, the NASDAQ was formed. So that was the first electronic trading venue. NASDAQ has a abysmal acronym to say, I can't even say the whole name correctly most of the time. By 1983, you started seeing retail investors getting access to electronic trading. Basically, news groups, so like Usenet, boards, people would post prices. So you could say, hey, I want 100 shares of GE at $1, and someone else could say, I'm willing to fill it at 99. The savings and loan crisis from 1987, which is kind of when a lot of options modeling kind of blew up. It was like the first example of where kind of the simplified models didn't work. Happened was accelerated by electronic trading. Volumes were about 100x what they were at the previous recession jump. But between the 1990s and early 2000s, we had a period where I would say that kind of resembled 2017. Basically, everyone could start an equities exchange. If you had a data center and you had sufficiently good redundancy, you could basically start an exchange in your backyard. You could provide prices, provide quotes. There was no real regulation on this. And the Glass-Steagall Act kind of also implicitly had some terms that made this more favorable in the US. But what happened when this happened was you had a lot of fragmented liquidity. So kind of like what you saw with crypto in 2016 and 15. The dot-com crash led to a large loss in a bunch of these companies. And the biggest ones, the biggest exchanges that were formed, Island and Arca got acquired by NASDAQ and NYSE, and then banks started acquiring some of the market-making companies themselves. But really, the big driver of decentralization of synchronization in electronic markets was this kind of fabled piece of regulation called Regulation Neutral Market Service, or Reg NMS. Reg NMS turned being an exchange into a distributed systems problem because it basically said every exchange has to quote the national best bid and offer. And that means you have to go to every other node in the network, every other exchange that exists in the US, take all of their best prices. So let's say there are 5 exchanges and 3 of them say $1 and another one says $1.01, and then the other exchanges say $1.05 and $1.03. You have to take the largest price someone is willing to buy at and the minimum price someone's willing to ask at. And that means you have to go crawl through the network, store all the ledgers query everyone's local ledger state being an order book, and kind of figure out the best consensus order book that you're promising to provide. This regulation kind of killed a lot of the mom and pops in the sense of people running exchanges in their dorm room. That became much more unsustainable because you got fined pretty severely for not providing the best price. And the financial crisis aligned the incentives for high-frequency traders and market makers with exchanges because basically volumes went down and exchanges revenues transitioned to co-location and data. And so what happened over time was that most players in the marketplace realized they were uncompetitive from the technology side. No one was building hardware. People weren't building machine learning algorithms that were sufficiently, at the right capacity level from a complexity standpoint. And you had the shift toward 80% of volume that exists being internalized by direct market makers and high-frequency traders. So this is why Robinhood is free, by the way. They sell your flow to Citadel usually. And Citadel basically gives them a rebate if Citadel earns a penny. So if you say you want to buy 100 shares of Apple, Robinhood sells it to Citadel. If Citadel earns a cent on it, Robinhood gets 1/3 of that cent. And that's basically the revenue sharing agreement that makes it transparent to the user that they're not paying fees. Somewhat similar to how gas fee arrangements look right now. And in 2018, we started really seeing the rise of the direct listings. So a lot of the IPOs in the current market started listing directly instead of like building a book with traditional institutional investors. So electronic trading has kind of like changed how banks operate, certainly has changed how IPOs operate. But let's look at kind of a little bit about what packet monetization means. So market makers are rewarded by two real functions. One is how far they are from a rebate tier. So the revenue sharing agreements between exchanges and market makers give market makers a significant discount on transaction fees, sometimes negative. So the exchange pays you if you provide liquidity. And so you as a market maker want to get your volume up as high as possible. And then you also want to provide price improvements. So you want to buy low, sell high, or sell high, buy low if you're shorting. And basically, the product of those two things is roughly what your profit and loss is. And this idea that you want to be the one who gets the most volume leads to this race where everyone gets a packet from an exchange, and you compute some estimate in your model of whether you think you should make a trade, and everyone is running to go make a trade at the same time. This is actually quite similar to the proof of work competition model. The difference is it's a latency versus bandwidth model. So in trading, it's really focused on latency, like how fast do you get to the market, whereas proof of work is really bandwidth, how much hash power do you have. But I did like this picture from the Princeton Bitcoin book of an FPGA mining rig in Georgia, the country, from 2012. And basically, people were still somewhat profitably mining Bitcoin on FPGAs until 2012. So it's kind of cool. So token economics. So fee rebates are wildly successful in every market that exists. That is an electronically traded market that's centralized. Even centralized crypto exchanges all offer tons of fee rebates. There's tons of, the reason BitMEX is able to have so much more liquidity than Deribit is strictly because of this. But decentralized crypto platforms have had a lot of problems with fee rebates. So there's a very famous example of this contract called Fcoin, which was offering over 100% rebates. So if you traded enough, you would get your transaction fee back plus a bonus, which means they were inflating the currency a lot. And then basically you had this huge crash because everyone was trying to get their volumes up and then dump as fast as possible. And so in the decentralized worlds, people haven't figured out how to make these revenue sharing agreements much more transparent. So I think the correct way to think about it is to really think about it in terms of some amount of algorithmic game theory and some amount of kind of continuous time modeling, like kind of what Charlie was talking about yesterday with Uniswap. So at the simplest case, the algorithmic game you want to think about is everyone observes an initial state, S0, on the public ledger at a certain time. Each party optimizes over the state space to figure out what they think the best state for their local objective is. Every state transition that you can take, so placing an add order, placing a cancel order, calling a smart contract function, costs a certain amount. And there's some variance to that cost. It's not exact. And your goal in compute and communication complexity is to efficiently find the most efficient set of state transitions to your ideal state, such that conditional, subject to kind of the constraint that you need that probability to be much higher than reaching other states. And the network value for both token economics and for trading comes from independent parties optimizing their own local microeconomic transitions while also maximizing social welfare. So what do I mean by social welfare? Social welfare is kind of whatever the macroscopic observable of the system that is trying to be optimized. So it might be income inequality, it might be the Gini coefficient, it might be liquidity because you actually want people to get in and out of their currency at the sizes that are desired or not. But what is kind of the formalism that exists for kind of looking at this? Realistically, it comes to algorithmic game theory, and we have one of the experts in the field in the room, so kind of anything I say, remember, if you should ask him real questions, not me. But two examples of kind of this microscopic, I'm selfishly optimizing but it actually works out macroscopically, is the VCG auction, the Vickrey Clark Groves auction, which is basically something where if everyone has quasi-linear utility, which means that they have they feel better when they pay less than what they think the value is of an object, linearly, then you can show that by doing a second price auction, the mechanism people maximizing their own valuation maximizes the global kind of allocation. On the other end, you have this other impossibility theorem, which is actually very cool, which is the Meyerson-Satterthwaite theorem, which basically says there's no ex post efficient Nash equilibrium when you are market making, so posting prices for bids and asks, when traders have independent valuations. And you can see this kind of diagram of the design space of these different types of macroscopic desires. So you may want ex post efficiency, you may want like certain types of incentive compatibility, and they don't overlap perfectly. So your design space, whatever mechanism you choose, has to somehow figure this out. And crypto and trading are interesting in the sense that they have social welfare functions that are time evolving. And these can be subverted due to mechanism flaws. Front-running DEXs, having a governance token that has no value, and then in normal markets, there's this thing between public and private data that kind of is a weird sort of mechanism flaw. So if we just go through, we'll just go through kind of like what this looks like for a couple things. In trading, each person's objective is dollar P&L, social welfare, liquidity, tightest spread. Who enforces this? SEC, CFTC, exchanges. What are your states' order books, your local account state, your local ledger? And state transitions are add, cancels, modifies, active fills. For Uniswap, and again, there was part of me that wanted to put more stochastic calculus in this talk, but I figured it's once we have one person already doing it, we don't need to. And basically, we kind of have a similar set of objectives. The difference is that the social welfare now is all token pairs have maximal liquidity for small size trades. And you want to maximize ETH-denominated P&L subject to gas cost restrictions. Stablecoins are very interesting because you have multiple types of users who all have different types of behaviors and different utilities and objectives. Arbitrageurs want US dollar P&L maximized. Users really want to just store their wealth without losing it, without getting inflated away, without having the price crash. And governors, in the sense of like a governance type of token, they want to profit from governance appreciation, fee deltas, burn mechanisms, so BNB, Leo, Maker, those are three different versions of how this appreciation might happen. And the social welfare objectives really just don't depeg very often and don't depeg by very much. And there's many different measures you can use for this, but at a very high level, that's what it looks like. And again, the contract enforces the social contract, and the states are everything in the contract. So what does this show us? Previously, we monetize single packets. Now we monetize aggregations of packets in a block, which is many state transitions, which gives us a much larger state space to kind of do this optimization problem over. And the bespoke thing is really the chain analysis kind of attribution attacks. And it turns out that there's a lot of weird restrictions from algorithmic game theory that show that you can't solve these things exactly. So we come to simulation. So why simulation? Number one, estimate the number of steps until you have a winner in a game. This happens a lot in reinforcement learning where you can't actually do this because it turns out your state graph has tons of loops and you get into a tit-for-tat type of behavior. And in these iterated tit-for-tat games, there's no winner sometimes. Estimate the computational complexity. Well, as much as we all love Brouwer's fixed-point theorem, I don't think people are happy to see PPAD as the complexity class of something that you have to deal with. And the last thing, prove that you're epsilon close to a social welfare minimum. This is, again, runs into this cursive dimensionality problem where in high enough dimensional processes, you're going to have expected exponential minima, exponential numbers of minima. And like in neural nets, you're not so sure if any minima is equal to the best minima or a good enough minima. So stochastic simulation is used both in the agent-based world and the macroeconomic world. The macroeconomic world is something like Black-Scholes or a Heston volatility model, something like closer to what people use for valuing real estate, options, etc. And you're not guaranteed to find equilibria, but you do find useful estimates, and you really do find these phase transitions. So this is kind of a simplified view of what a phase transition looks like in a physics model, something called Ising model, where you can see kind of no consensus up top, where everyone's kind of random, and kind of in the bottom, there's kind of this notion of consensus. there's a blog post where I formalize this. And I'm almost done. So this is basically, what are the pros and cons? The pros, it's computationally efficient, tractable, and it can be statistically rigorous. You can apply Cheeger's inequality. You can bound mixing times. You can do your traditional Markov analysis. This is not like something where I choose a prior and I can't tell you whether it's a consistent estimator. The cons, an exact, only kind of tells you something's wrong, and it relies on your parameterization of the search space. You could do the fully machine learning route, but I will say in trading, if you don't simulate against the real infrastructure and you have a too high capacity model, you will lose money. And at the end, my friend Noam, who worked at Facebook on poker, he won this, was the first, made the bot that does the first, beat the first humans at poker, has this good quote that markets are really like Go, except the board is changing at every step. And the very last slide I have really is how does simulation affect adoption? Basically, what happened was the Black-Scholes equation, once introduced, increased options trading significantly until the savings and loan crisis, which is when volatility smiles, if any of you have ever traded options, were discovered. And then you saw the rebirth of options trading right around the dot-com boom, and then this huge growth after that due to the ease and efficiency of electronic markets. I could quote any option really deep out of the money if I wanted. And once flow internalization happened, so this is a picture of Ken Griffin of Minority Report, evil villain, you saw things kind of level off. And us, we do this. We work with a bunch of people. We do everything from network simulation to economic simulation. And yeah, that's it.